Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for the week ending Friday, January 28th, 2022. Here's what I'm going to do in this video, and we're just going to walk through the charts of the major stock indexes. I'll cover not just QQQ SPY, but I'll cover the small and the large caps, and the mid caps and the Dow. That won't take long. I'm just going to show you the charts on one time frame on those. We're not going to go through each chart, each index on all the different time frames. But on the main ones, we'll walk it down, and then I'll also just do a quick overview of where we parked the week on the all the 11 sectors in the S&P 500, and then just a quick overview of the market-leading FAANG stocks, the top 5 or so, half dozen or so holdings in the S&P and Nasdaq 100. Sounds like a lot, but I think I can get this one done in under 25 minutes. At least that's the goal here. But again, the market is simply a sum of its parts. The market consists of thousands of stocks, but if you break it down, looking at the individual sectors and then the market leading stocks, because these are cap weighted indexes we're trading, whether you're trading the SPY or QQQ, that's really all that we need to look at. We don't need to look at all 500 stocks in the S&P. Okay, starting out here on the very shortest term time frame, then we're going to go work our way up. So that's that 5-minute bullish falling wedge I pointed out this morning in the video, and then we had a downtrend line that I added there, and so that was taken out. So what happened here? You had a breakout. Again, the 5-minute charts have been just trading very, very well lately. You had a breakout, and then you hit that trend line there, it pulled back, and a leg up. Which actually was right here. I took the measured target of the wedge. If this point here, when you have a bullish falling wedge or a bearish rising wedge, if you take the widest part of the wedge, at least this is there's other formulas you're going to get from other people and other means, but this is the most accurate and most simple that I've found. Plays out quite often. You just take that widest part of the wedge and add it to where the wedge broke out. It gives you a measured target. So, that measured target's been hit. Doesn't guarantee you stop there. I mean, we closed there today. Don't worry about these white bars or their errant candles. This is where we drifted a little higher after the close, but we're pretty much almost perfectly at that measured target. That's very short-term stuff. Now let me go into longer-term charts. Let's walk it out. Number one, I want to say I'm going out here to a 60-minute chart. And just wanted to add that one thing during clear, powerful corrections, solid corrections, 10+% corrections in a bull trend, I usually like to see, it's not an absolute necessity, but you usually get it, I like to see a positive divergence on the 60-minute time frame, and that was our recent low. So in QQQ we never put in a lower low, so we don't have positive divergence. We have higher highs on prices and higher highs on the indicators, so that's one thing to note. And I told you I'd walk you through the different sectors. SPY, no divergence on the 60-minute chart. The Dow is DIA is the tracking ETF for that, no positive divergence. MDY, that's the mid cap sector, you do have divergence on MDY, but again, it's the large caps that are going to dictate where the market goes. But then this is something to note. What this says, if the markets do rally next week, then this one probably has more upside in it than the big caps, the large caps, which were usually, that's what I'm trading. And then the small caps as well, same thing. You have the divergence on the IWM, which tracks the Russell 2000 index, and probably want to put a trend line there and see if that gets taken out. But I'm going to walk to the longer term time frames here too and show you what I see there. So in summary, the small and mid caps, which got hit harder on the way down, they have the divergences. And so if the market does bounce next week, they'll probably outperform, would be my guess there, based on the technical posture, at least on the near term intraday charts here. All right, let's go queue back up the queues and walk it out to a daily time frame. So nothing much has changed. We're still, that move today took us to the top of the flag. This is just a downtrend line that I have here, which you can see QQQ closed perfectly on. It's right there. It comes off the high of this candle, if you want to replicate that. The candle from January 13th comes in, pretty much touches the top of this candle here on the 20th. And then close to that one there on the 26th, and that's about where we parked today. And that's also here. We'll turn everything off so you can see. It's right about in the top of the flag there, the pennant. So we're really pushing the limits of that. Again, next week, if we pop it, then there's no more bearish pennant. Doesn't mean we can't go down, but it just says, look, there was a potentially bearish setup and the bears failed to capitalize on it. And then that would probably open the door for a move at those tests for the 200 days. Remember, QQQ is still well below the 200 days. In fact, let me try to give it to you in percentage terms. From where we closed today, the 200-day exponential moving average, should it get back tested, would come in about 3.25% above today's close, with about a 3.9%, almost 4% to test the 200 simple. And then you still have this level here, very important, the bottom of the recent trading range right there. So that's still, on the Qs. Max bounce target. If we get that all the way up here, it's going to take the SPY back within its comparable trading range. But as of now, this is where we're at, and I still favor going home short. I know that anything can happen. I think it's a good weekend to lighten up, like last weekend, not go too crazy. Any weekend when you have volatility this high. And the reason is that when the VIX starts moving up, volatility expands. 3% up and down days like today and the last couple days are just par for the course. And so if you're positioned properly, 3% move against your position, especially a swing trade, shouldn't really impact you at all. In fact, if it does, then you're too heavy. Old rule in investing and even active trading is sell down to the point at which you can sleep at night. So, swing trader by definition goes home, takes position home. Day traders are out flat by the end of the day, so they don't have that overnight risk. So there it is. QQQ still well below the key moving averages and all the breakdown points, all the sell signals we've had over the last week. But on the flip side, a near perfect tag at the bottom of my first target zone on both the daily and the weekly chart. And as I continue to say, support is support until unless broken. So I view this as simply the reaction on the initial tag of that level. Like I said, maybe the consolidation is all we need, and the next leg will begin next week. If so, just look for a break of the recent lows. Otherwise, I've given you areas to bounce up to. There's that level right there, about 378.86. Roughly, we'll call it 379. That's the bottom of that range. So that's really about what ideally should cap any kickback rally in QQQ. And if it just craps out next, let's say we gap down on Monday, futures start tanking Sunday night, then you're going to gap down out of those potential bear flags. That's going to be even more bearish. And then I think it'll be a quick ride down to my second target if that happens. So we're on the weekly chart. Let me go back to the daily on SPY. And there's your still within the flag. There's your flagpole, bear flag pattern, bearish pennant. No, flag, I'm sorry, that's a bear flag. And boom, if it breaks down, probably take you down to around my 397-ish target right there on SPY. Also about 395 on the weekly, depending on which time frame you're looking at. And all this is you can see a simple back test, a break and a back test of that 40-week moving average, which is the 200-day exponential moving average there. And that's it. So all week I've highlighted the fact we took out the 200 days, and we've been back testing the last 3 days. The 200-day simple moving average has capped all these kickbacks. It's right here in blue. I don't know if you can see it. It's those recent highs. So really, that's it. Break much above today's highs is going to foil the flags and probably then lead to a back test of those levels. Whereas a move down to next week, you don't have to. It'll certainly help to take out the recent lows, but simply a break below those flags or the consolidation over the last few days. If you look closely, this is about where SPY has been pulling back to. You can see it better in the futures. Maybe I'll get to that in a minute. But I want to I don't want to go too long in this video. That's the same story. We're basically where we're at the last few days. We're consolidating after taking out some key levels, consolidating just above big support. Again, the first target on the Qs, the first swing targets, that is, not to be confused with active trading targets. We hit T1 through 5 on the 60-minute chart already. That was for active traders. We've been hitting pullbacks along the way in the bull trend longer on, but now I've turned my focus to the daily and weekly charts. So I just wanted to clarify that. SPY, S&P 500. All right, we did that. Let's look at. I told you I'd look at the small and the mid caps as well. Let's start with IWM. because that's one I trade a lot. I gave you midweek. I gave you that target there. I told you that's probably where we're going to get our first reaction. And it's really still, this is my sole price target, but that was an area where, of course, again, large caps hit support, SPY and QQQ, so you're going to get the same consolidation in the Nasdaq, I mean, in the Russell 2000. And that's it. So we need to take out that level, about 192. And from all accounts, I don't see anything to make me want to be long. And again, we may bounce. I'm speaking now in the trend trader slash swing trader mindset. Whether we do that or we've had enough consolidation, we just do that, I still maintain that target of 171 based on everything I see on the charts. When will that might change my mind? Well, you know, if these bottom of these ranges that got taken out we move back above there. There's the 40-week moving average, that red line, also acting as support, and it was taken out recently. So by all metrics, this one's on just fresh into the beginning of a deeper correction, in my opinion. Big negative divergences, as I mentioned. And mid caps or MDY, if you want to trade that, tracks the S&P mid-cap index. I think it's the mid-cap 400, if I'm not mistaken. And well, 400 stocks it is. There's 462 is big support. So this is one actually that hasn't taken out the recent range. And the takeaway of this was I go over all these charts. We're just sitting this week's lows. We just hit this week key support levels. We broke support on the large caps, and that's the main thing, and the small caps. The mid caps has fallen down to really a comparable support level. So the takeaway again is the next, you know, what happens next week or the following week if we continue to consolidate. If we take out the recent lows on all these indexes, there's a big drop coming, I believe, guys. This honestly doesn't guarantee we're going to get it, but that's what I see in the charts. And on the mid caps, if you wanted to swing down MDY or any of the other proxies, that's another 17% downside till we hit my target. So similar to IWM, I have a pretty aggressive target there. You can look at the Dow. DIA is the tracking ETF for the Dow. This is a weekly chart we're on, just like we were looking at on MDY for a second ago. This, to me, as I look at it here, looks like a megaphone pattern, which is aka a broadening, a broadening wedge pattern. And you have, 1, 2, 3, you got nice 4 taps up top, several taps on the bottom, and again, it doesn't have to break down, but if it does, then I think that's going to take you down quite a bit on. In the Dow. Again, I don't trade the Dow. It's only 30 stocks. It's just not my cup of tea. But if you do, that's my target right there, 296.72. That means from today's close, if that target's hit, the next target on the Dow, you'd about a 15% drop. And if the Dow drops 15, the S&P is going to drop 15, give or take. They're very similar. All right. What else did I tell you? That's it for the weeklies. And then finally, the monthly charts. Let's just go back here. Let's start out with my beloved Qs. And so what I see on the Qs, as I mentioned many times, today's the 28th, so we have 29, 30. So one more trading day? If my math is right, Monday for the month. No matter what happens, we're going to have this red bar here. And again, I've gone over all the corrections that have been associated with each and every one of these crossovers in the PPO where the histogram goes red. Without exception, we're going back decades here. Without exception, you've had drops ranging from, the lowest was 13%. The highest was 55. So you're just eyeballing the averages well up in the, probably about 25% or so, somewhere in there. And again, so is it possible this is over, or we're going to reset the, lower that average? So far, we've only had in the Qs, again, from high to low, what was that, about 17, almost 18%. So we're certainly on the more shallow end of that. So it is possible that it's over, but from the looks of it, I don't think so. I think there's going to be more downside. I think it's the first red bar with more to come. And again, the longer term, we'll probably hit this uptrend line. That's a beautiful uptrend line. And it needs to be checked. Even if we're in a longer term bull with a lot more life in it, technically, the media will march out and talk about bear market if we hit that, because we're going to be down 35% or so when we get there, 35%. But you know, bigger picture, it's still a secular bull market. You can call this a cyclical bear if you want, but that's where I think we're going, and I think we're going to hit it in 2022, and I also think it's going to happen sooner than later. I think we're already starting to see the crowded rush for the exits. I think a lot of investors and institutions learned. They tried to wait till the 11th hour to start, you know, reducing risk on assets, especially high flyers like tech and all that. And I still think you're going to continue to see more and more money coming out, more and more profit taken. Anyways, that's my guess. We'll see what happens. You know the levels to watch. You know, it's not like you have to sit there and put everything short or long. If you want to keep it, you know, relatively light, or if you're, you know, already covered shorts because we hit targets and you bounce, you want to get back short, you know the levels to watch. You can either short into resistance, which I still like, and or short breaks of support. And that's what I just spent a bunch of time on, what those levels are. All right, so there's QQQ, and then SPY. Close but no cigar. But again, the month isn't over. You can see this. And again, you just look at these histogram bars, which is you know, visual representation of the difference or the differential between the PPO signal line and the PPO line. Shows when they cross. That's the white and blue line down here. And you know, when they cross on the monthly, again, we're not talking a 60-minute chart here or the 5-minute chart I just saw. This is the trend trader, the investors, like 401k type stuff, or hey, get long and stay long, or get short and stay short. So, you know, that one came early on before that 57% drop. This one here, well, let's measure high to low. I didn't measure it out. I'll do that real quick. That's about a 22% drop right there from high to low when we had that crossover. So, like I said, just look at the odds. That one's measured out 15%. And we had the crossover there with a little whip, but it was still followed by a 20% drop. And then another one there, followed by a 36% drop. These lines, you can see the PPO line down here. Anything's possible, but usually when it rolls over all the way over and pointing straight down, you're going to get that crossover. It's just a matter of when. There are no guarantees. Sometimes the lines bounce, but I just wanted to kind of show you, again, that's the takeaway of this video, the technical posture of all the indexes. QQQ already fired, IWM already fired. I'm talking about the PPO crossover that is now at this point. Nothing can happen on Monday to cross these back above. There's not a rally that could take place in the market big enough to get those back up there. That's small caps, mid caps, already crossed over right there on the monthly. Last time, you can see here, these are just great shorting ops. You want to, you know, either get out of longs or get short, especially when you see it about to happen. And again, with other things too. Like I said, well, MDY gave you, for example, you're at support. Where was it on the weekly chart? Yeah. So you don't short it now. You can might as well just wait for the break of the recent lows, and then you have a much higher probability of getting that 15 to whatever 17% drop. That's it. So I covered small, mid, large. Did I? Yes. SPY or the Dow I didn't cover, but the Dow is going to look like the SPY on the monthly, and that is just close. 0.1. In other words, the PPO, any more downside, it's going to cross. Hasn't done so yet, and there's a long-term trend line for the Dow, likely target. All right, so that is that, and I will wrap this up by just showing you the sectors of the S&P and then the leading stocks, and we'll wrap it up for the week here. Okay, the biggest and most important, XLK, tech sector, makes up about a quarter, 25% of the S&P 500. Remember, there's 11 different sectors in the S&P, but the top sector determines a quarter of the weighting of the returns. And that one has just got that, you know, it's basically a mirror of QQQ. It's got that nice textbook-looking bear flag right there, and so we'll see whether or not that plays out next week. As far as resistance and support levels, it kissed support perfectly. Obviously, when QQQ hit support, so did XLK, because again, QQQ is over 50% in tech. And here's the holdings of XLK. I haven't updated it recently, but it's just, trust me, it's pretty much the fangs are going to determine where this one goes. And it was hit that level. I had it here for a while, 146.86. Hit it to the button there, and then bounced. And it's coming right up to that key level here, I had the yellow lines as the important levels. That was 159.91. We'll call that 160. Remember, that was the previous all-time high. We had a breakout of that level. We had a successful back test right here, and then a failure. So this right here, this whole thing, this happened in the last couple weeks, is a bull trap. Yeah, bull trap, false breakout. Not only did you fall below the 160 level, you also fell through below this trend line here, and so they are very significant resistance just overhead, and that's why, you know, I favor being short at this point in time. You know, if the correction's over, no big deal. If it goes up much more, you can stop out. There's objective levels that quote unquote should contain any bounce here in XLK. Okay, and next up, XLV. What stands out to me, there's a lot of lines on this chart, but you have a nice clean trend line here that goes all the way back there. Lots of reactions along the way. We're below that one. And another flagger. That's the common theme here, is look at these bear flag patterns. So, and again, if they're going to play out, now we're at that point where these flags are about fully mature. In other words, if we just consolidate anymore, they get too long relative to the flagpole, and they're no longer flags, at least not my point of view or my opinion. So again, watch what happens next week. Should there be more upside and the flags get foiled, you have the trend line to contend with, you have price resistance, and so forth. And if you're an Elliott waiver and you're counting, looks like wave 1, 2 up, 3 down. 3 is always the most powerful. 4 up, and you'd have 5 down, would take you to my 121 target right there. So we're also testing the close right on the 200-day moving average, a simple moving average. XLV healthcare, that's about a 16% weighting last I checked. XLF, the financials, been diverging for a while. These big divergences continue to build. That shows even better on the weekly chart. Broke down from this small wedge and back test. It broke the primary trend line here months ago, back tested, a perfect back test, and then broke that minor trend line. That was your sell signal most recently. Pulsive wave of selling, hit nice support. Again, it's not mere coincidence that just about every sector hit support right when the stock market hit support. That's, again, what I said in the beginning of the video. That's why I do this. The stock market is simply a sum of its parts. These are the parts as measured by sector, and obviously we're not going to go over thousands of different stocks that make up the stock market, so we'll just look at these. And that's it. Same thing. Flagging action there, right back to resistance. This is a big resistance level too, by the way. 38.90, so we'll call it about $39, give or take, and that's where it parked. So this is a story of this week. We hit support, we bounce back to resistance, and to be continued next week. Next one up, Xlc Communication Sector, aka Facebook and Alphabet, because last I checked, it was been about over a year, no, 6 months. They made 44%. 2 companies made up 44% of this sector ETF, and this is Xlc Communications. What do I see here? You have a nice downtrend line to watch. The bulls want to see that get taken out. Bears don't. If they do, there's still plenty of resistance overhead. You can see the levels here on this chart. But again, another one that's flagging right now. And so if next week it's can come out of here, out of the gates early next week and take that out, we're probably going to, those flags will probably play out, and that should take XLC down to 65.40-ish right there. Should there be any more upside, you know, even if they foil the flags, there's still plenty of resistance. $75 and then the downtrend line. They got to get through those. XLY, consumer discretionary, trend line taken out, divergent high right here, and we've been walking lower since that divergent high. Like everything else, all these sectors hit nice support, 173.54 this week, and it's been consolidating on there, pretty much flagging as well. Flag, look at this one, broke down from the flag. So again, if we can take out the lows next week, boom, should drop. If we rally back, bearish case is still intact until I see these levels, these yellow lines go. Alrighty, next up, Xli Industrials. Look at this range right here. See, this is it, guys. We're going to get a big drop in the market. It's going to happen soon if we take out the lows, because we have so many big support levels. 97.80, that's just multi months. We had an all-time high here, broke out, and we've been back testing it in this sideways range now for almost a year. And again, I talk about how that's akin to building energy like a coiled spring when you get these ranges. So bulls want to see an upside break, bears want to see a downside break. Downside break will bring you at least, I think, to 90.25 with a hiccup along the way here at about 93.80. All right, XLP next up. Sweet little, look at that beautiful little bearish rising wedge. Broke down, pointed out a little bear flag right there, which then played out. And XLP 73.30. Better fish to fry, in my opinion, because you don't have, number one, you didn't have negative, you had RSI divergence, but these are consumer staples. This is a defensive sector. Defensive sectors tend to outperform during bear markets and corrections. That doesn't mean it has to go up. It just tends to fall less because of the nature of these companies. They're staples, products people need and use no matter what the economy is doing. Alrighty, next up, energy sector. Energy gave us that nice divergent high and a sell signal recently on a break of that steep uptrend line. Had a couple down days, kicked back, and all we've done is extend, made a marginal new and still divergent high right there. And so this one still looks to be headed lower in the coming weeks. XLU utilities, it's not going to move the needle on the S&P. It only makes up about 3.5%, but also a defensive sector, so better fish to fry. But it did break down, put in a divergent high here, broke down this week, and is back testing the trend line and this nice, really nice price resistance, $68 from below. I think SDP, if that's still around, is a 2-time short utility ETF. But again, you can definitely oversize your position in utilities because they don't go up and down nearly as much as tech. So you can see some potential targets there. But the bottom line is all these charts look the same to me, or very similar, I should say. Coming off some divergent highs. XLRE, we nailed this one so far. We used SRS, so it was my preferred proxy, or IYR. I just use XLRE when I'm going over the sectors because they're, we're looking at the components of the S&P 500, and that's the same company, that manages the S&P 500, so I use those sector ETFs. But for trading, iWire was the first to market, and it doesn't get much better than this. We shorted it in anticipation of a breakdown, kind of like the trade on cotton I put on today. It hasn't broken the primary trend line yet, but I anticipate that it will based on the technicals, and that played out. We flagged there, right above there, hit my first target, and then went on to perfectly, gave you multiple exits there at T2, and then we bounced like everything else. It hit support, and this is the usual reaction. But here's the thing, right back to that T1, that's still resistance. And look at these 200-day moving averages right here. There's the, in red, the exponential and the simple. They come in together, so you have a confluence of resistance just overhead. That's the theme here. Same with the S&P 500. You have the 200 days, you have price resistance, and all right, I hit somewhere along the line, I hit the pause button, and I realized I went to unpause it after I finished talking. It started the video. So I hopefully was on SRS and IYR, just got to that, but I'm going to go over it again just in case. So this one, I was on DJUSRE before, which is I'm sorry, not DJUSRE. That is the index itself, the Dow Jones U.S. Real Estate Index. This is IYR, the REIT ETF. So we shorted this one right here. It had a bear flag. It went down, hit T1, and then we hit T2 all week. And that's the thing. Support is support unless broken. And it's not mere coincidence. Again, all these sectors had well-defined support when the market hit support, and that's why we've been consolidating. So story is the same, just like the stock market. This one is smack between support about 101.50 and resistance about 105.36. You also have the 200-day simple and exponential moving averages both coming in at this week's highs, so that's what's been capping this. And if you took SRS, that was the preferred swing proxy for it with the 2-time leverage, and it actually gave us about, put that on as a trade idea here. I think it was good for about a 25% run, and you can see it reversed a little shy of my target, but this is what I was talking about when I thought the video was recording, is Always go off the non-leverage. That's why I post the charts, even if I give you a leverage ETF, because of the decay that the leverage has. Over time, the charts are going to be distorted. The reaction points aren't going to line up. So that's why you want to use this. So you had multiple chances to get out there to play the bounce or get back in. And that's where I think things are going. I'll come down here and hit my second or third target there. Probably get a reaction there, and then ultimately my final target down there. The only other sector is basic materials. I'm not going to spend a lot of time because it's not going to move the needle either. About a 2.5% weighting. Same story. Bear flag. You can see it. Look at that impulsive move down. Bear flagging. And so next week, if market drops, that should take us down to about $79. And then you want to cover any shorts in XLB because you'll probably get a bounce there, reaction there. Alrighty, the top components of the Nasdaq 100, and I will let you guys get on with your weekend. Apple, the strongest of the bunch. Market liked earnings. Forget about that wonky candle here. Let me turn that off here. It's going to show a distorted candle. What am I doing here? No, pre-post data. Turn that off for now. Okay, there's what Apple did today. So Apple gave you this trend line the other day. Apple broke above the trend line. It also hit really nice support. Again, when the market hit support. It's not mere coincidence. All the sectors, most of the major stocks hit support. And so that's a bounce. Back to a little bit of an overshoot today, momentum fueled overshoot at that level. But again, strong because it took out the trend line and had a nice day today, up 7%. But let's look at the rest. So that's more of an outlier when I look at the market leaders, because when you look at Microsoft, it also just barely managed to punch through, and it did. It took out the trend line, but look, remember these yellow lines? Microsoft has to get above. These are big levels. That gave us sell signals, and they're still well below the primary trend line. So any more upside is going to be met. It doesn't mean it can't take it out, but you got a lot of resistance overhead. So again, we'll see what happens with the market next week. Alphabet still flagging. There's your nice little bear flag. And if we rally next week, Alphabet Class A has 2674 to resistance, big resistance. Look at that level. That's why I had it color coded yellow. That was a big breakdown for me. So that's what I think is going to happen there. We'll wave down. If it takes that level out, it's got pretty big resistance up there, about 2800 as well. And probably have a downtrend line that'll come in there. Next up would be, let me go back to the queue so my watch list loads. Amazon, pretty nice support right here, but look at that flagging action. Same common theme. Again, flags can be foiled, and if they are, you have resistance right here at 2944-ish right there. But if we come out of the gates to the downside next week, especially impulsive, watch those futures on Sunday night. That's when it'll let you know. I think it'll be that waterfall drop just like it was leading down, because that's the nature of a bear flag. Waterfall type selling, impulsive. And that's it. Let's see, anything big on Tesla? No, Tesla's still below trend right here. There's your trend line. Close the week right above support. And that's it. Netflix doesn't move the needle anymore, but it's still at that, actually it's a little below that support level there. If you look at it this way, Netflix almost looks to be flagging too. I mean, we had an impulsive drop. A gap down is a drop. You don't see candles, but again, that's where it went. And it also looks to be flagging just below that support level. I told you I bought it the other day when I mentioned it here. Went down, then I decided to get out for a small loss based on my expectations that there's going to be another leg down in the market, and Netflix will probably go on. And again, whether it bounces, maybe the market bounces next week, but I think it'll ultimately come on down here and have another leg down. But we'll see. And again, why do I say that? It's everything. It's not just the chart of Netflix. It's my analysis on the market, long-term views, things like that. And ultimately, before all said and done, Netflix could have a lot more hot air to let out of it. So we'll see. All right, guys, let's wrap it up here, and we'll pick it up Monday. That's it. If anything goes crazy on the future Sunday night, maybe I'll get a post out to you guys. If not, let's see how we open on Monday, and we'll go from there. This has been Randy Finney with Right Side of the Chart. Have a great weekend.